Hello and welcome everyone. Today's videos is about swaps. In this video, we'll be discussing what swaps are, how they work, and some of the common types of swaps that are used in financial markets. What is a swap? A swap is a financial derivative that involves the exchange of one set of cash flows for another. It's essentially a way to trade financial instruments or risk exposures between two parties. Swaps can be used to manage financial risks, such as interest rate risk or currency risk, or to optimize financial exposures, such as borrowing costs. Swaps are typically structured as over-the-counter, OTC, derivatives, which means that they are not traded on a centralized exchange like stocks or futures. Instead, they are privately negotiated between two parties, often with the help of a financial institution or broker. One of the key benefits of swaps is that they allow parties to tailor their financial exposures to meet their specific needs and objectives. For example, if Party A has a loan with a fixed interest rate, and Party B has a loan with a floating interest rate, they could enter into a swap agreement to exchange the cash flows from their loans. Party A would pay Party B a floating interest rate on the loan, and Party B would pay Party A fixed interest rate on the loan. In this way, both parties can manage their risk exposures and achieve a more desirable interest rate for their loans. Types of swaps. There are several different types of swaps that are commonly used in financial markets, including interest rate swaps. These involve the exchange of interest payments between two parties, as we saw in the example above. Interest rate swaps can be used to manage interest rate risk, or to optimize borrowing costs. For example, a company with a floating rate loan may enter into an interest rate swap to exchange the floating rate payments for fixed rate payments, in order to hedge against rising interest rates. Currency swaps. These involve the exchange of principal and interest payments in different currencies. For example, Party A may have a loan in euros and Party B may have a loan in US dollars. They could enter into a currency swap to exchange their cash flows in order to manage currency risk. Currency swaps can be used to hedge against currency fluctuations or to access foreign financing at more favorable rates. Commodity swaps. These involve the exchange of cash flows related to the price of a commodity, such as oil or gold. Commodity swaps can be used to hedge against price fluctuations or to access physical commodities at more favorable prices. For example, a company that uses a lot of oil in its operations may enter into an oil price swap to hedge against fluctuations in the price of oil. Credit default swaps. These are insurance-like contracts that provide protection against default on a bond or other debt instrument. Credit default swaps can be used to hedge against credit risk or to speculate on the creditworthiness of a bond issuer. For example, an investor who owns a bond may purchase a credit default swap to protect against the risk of default on the bond. Swaps are a useful financial tool that allow parties to manage risk and optimize their financial exposures. While they can be complex, with a little bit of understanding, you can see how they can be a valuable tool in a wide range of financial situations. Thanks for watching. If you have any questions or want to learn more about swaps, be sure to leave a comment below.